Welcome everyone. I'm so excited to be here and to share 50 years of knowledge on studying the world of money. So, the title of this webinar is Pay Zero Federal Taxes, just like President Jimmy Carter did in 1976 and Amazon did in 2017 and 2018. Who is Dr. Wong? Well, my PhD I earned it in economics in 1974. I passed the national CPA exam in 1979, one of only 4% that passed all four parts of the 3-day exam on the first try. Guest tax expert on over 400 TV and radio shows, and amazingly set audience records on 50 TV radio stations from California, in California, from San Francisco down to LA. For 8 years, I wrote the only financial column for the community section of the Arizona Republic, the largest daily newspaper in Arizona, and my research was distributed to over 2,100 newspapers throughout the US. Now, this is kind of personal to me, why I got into this field. My clients are my extended family. My wife Debbie and I have no kids, and unfortunately, our rescue dog Scooter just passed away a few months ago. So, my clients and all the people I've educated through my radio shows, TV shows, website articles, and my columns for different newspapers are my extended family. My parents came from China and were cheated by Wall Street investment brokers a number of times. Absolutely devastating, the heartbreak for my dad, who never made more than 50,000 a year, to lose 70,000, for example, in one scam. So I vowed to educate Americans to do these things: maximize retirement income, minimize stock market risk, reduce or eliminate taxes, afford medical and long term care expenses, and afford to help your kids, grandkids, and to enjoy your bucket list dreams. Is it really possible to legally pay zero taxes? Well, in March 1980 was my first media appearance. It was 2 hours on KCBS, the CBS radio station in San Francisco. I was shocked, just like the station, that find out that I set the all-time response record with over 3,000 letters and phone calls. But here's why. I showed how Jimmy Carter paid zero income tax in 1976, the year he was elected president, and also how the listeners could. What I said at the end of the 2 hour show is I believe the law applies to everyone equally in America. The average taxpayer with enough knowledge should be able to pay as much or as little taxes as his presidents do. Here are what happened for Jimmy Carter in 1976. He was elected president in November 1976. Now, in 1975, his adjusted gross income was 136,926. By the way, in 1976, the adjusted gross income dropped. It dropped by over 80,000. So his tentative tax for federal income tax in 1976 was 11,675, but he owed zero because he had depreciation and investment tax credit on 208,649 of peanut processing business equipment. Remember, he was the peanut farmer. And the excess investment tax credit, after wiping out his federal tax to zero in 1976, could go back and recover up to all the federal tax paid 3 years before getting elected president. So I've used this as well as other powerful tax strategies for 40 years to allow people to pay as much or as little taxes as they want. It's nothing weird. It's not offshore strategies. It's just what Jimmy Carter and a number of your governors and a number of your other presidents have used. And here's more details on Jimmy Carter. His logo in his campaign uh, was a new spirit, a new commitment, a new America. He was embarrassed when he found out he owed zero income tax in 1976. He received a $70,000 check in early 1977 for a book advance. So he asked the IRS, can I please reflect that on my 1976 tax return? Of course, they said no. You haven't received the check in 1976, so you couldn't have cashed it. So he was so embarrassed that he owed zero tax, again, for the political appearance, he actually wrote a $6,000 donation to IRS. But it's not just Jimmy Carter, not at all. In 2018, there are 60 big corporations paid no income tax, no federal income tax at all on $79 billion of profits. Now, you probably recognize the number of these giant corporations: Amazon, Netflix, General Motors, IBM, John Deere, the green equipment for farm equipment, and Berkshire Hathaway, the Warren Buffett company, the conglomerate that owns about 80 different companies. They legally paid zero income tax in 2018. Now, if I were to meet you, and I hope to meet most of you in person at my office in Tempe, Arizona, I would ask you to bring your presidential medal that you were given at the White House Rose Garden, your medal for paying taxes for decades. I look forward to seeing your medal. Of course, we're all joking because no one's ever been given a medal for that. In fact, if you paid any federal income tax at all, you probably pay more in federal income tax than some of America's biggest, most profitable corporations. Amazon, which has made their owner Jeff Bezos the richest guy in the world. 2017, they had 5.6 billion of profit, paid zero income tax. In 2018, they had 10.1 billion of profit and paid zero income tax. In 2017, Amazon paid 13.7 billion to buy Whole Foods. And we know the nickname for Whole Foods if you've ever looked at the prices. Whole Foods means whole paycheck. Watch the webinar to the end and you'll discover how I'm going to save Whole Foods lots of taxes. Could be as much as 15 million of taxes this year. Now, a lot of people would like to switch from having the IRS shaking you down for your money to recovering taxes paid even last year. We're in 2021, so the ordering rules are similar for what Jimmy Carter faced in 1976. If you use powerful tax reduction strategies, it allows you to reduce tax to zero in the current year. So that'd be 2021. And the law says we can go back and recover up to all the federal taxes we paid in 2020. And if we still have extra deductions, we can carry it forward under current law for up to 20 years. Now, continuing on, Americans pay more in taxes than for housing, food, and clothes combined. You have no idea. It's not just federal and state and city income tax. There's sales tax. In some states, it's 8, 9, 10%. There's real estate tax on your property you own. There's the registration for your car. You have no idea how much taxes there are. Now, the top 10% in America pay 2.5 times the total tax of the bottom 90%. So when they say successful people aren't paying enough tax, they have no idea. They haven't looked at this chart. Imagine if the federal government said, okay, everyone in the top 10%, we're now going to move 2.5 times 9, or we're going to have to move 22.5 people into your house. You're going to have to pay for their housing, so you probably have to buy 5 more houses. You have to pay for their cars, for their kids' medical expenses, for adults' medical expenses, for their clothes, and for their entertainment. There'd be an armed revolt in America if the government forced everyone in the top 10% to absorb 22.5 more people and to pay for them for the rest of their lives. Now, it's an amazing statistic, but 45% of Americans pay no income tax. They may pay some Social Security payroll taxes, but they don't pay any income tax. Is this fair? In other words, only 85 million in America pay federal taxes. So guess what? If you have no skin in the game, the rest say, well, let's raise the taxes on the 85 million who pay taxes and give me more free stuff. It's just human nature. Any of you had kids and grandkids? Yeah, money flows in a one-way stream. When they say, Grandpa, Grandma, I need some money for a bicycle, you know what you do. Now, this is a slide that I think says a lot. Welfare, you work hard so they don't have to. Now, there's all sorts of fraud. Government is not very efficient in spending money or distributing money. Recently, with the coronavirus pandemic that started in March of 2020, just in the last year, over $1 billion in fake California unemployment claims are paid to people actually in prison, including famous murderers like Scott Peterson. It's ridiculous. And this guy, David Hines in Florida, bought a Lamborghini with your tax money. He was able to defraud our tax authorities out of 4 million on that payment PPP money. So, it's payroll protection program. Just terrible. Here's what I believe. I believe your kids and grandkids deserve your money more. Now, why is it Americans don't save lots of income tax? Well, the Tax Reform Act of 1986 targeted tax shelters and eliminated major tax saving strategies, such as the 10% investment tax credit that Jimmy Carter and many others used. In fact, that tax credit was put in by President John Kennedy because the economy wasn't doing well when he got elected, and it did work and it kickstarted the economy. Also, there's stiff penalties and tax preparers and CPAs. And then the third factor is fear of the IRS and unwillingness to pay for major tax planning. Let's go to penalties on tax preparers and CPAs. In 1981, we had a terrible recession caused by incredibly high interest rates. A 30-year fixed rate mortgage was 18%. A second mortgage was 21% and 10 points up front. So if you borrowed 10,000, you had to pay 1,000 up front and it's 21% interest. Terrible, terrible unemployment. At that time, the federal government figured that at least 10% of the economy was underground, meaning I'm a printer. I don't have cash. I need some plumbing work done. So I find a plumber and I do a barter. He does the plumbing work and I print some stuff from him, but nothing is translated into cash, and so it's not taxed. So the federal government estimated as this recession continued that we would go from 10 to 15 to 20% or more of the economy underground. So they said there's only one way of solving that. We're going to turn tax preparers and CPAs into quasi agents for the IRS by threatening them with penalties, such as a penalty of the greater of $5,000 or 75% of the income derived from doing that tax return. There's fraud. There could even be prison and a penalty of up to $500,000 if you do corporate tax returns. So here's the bottom line. Is your tax preparer or CPA more worried about penalties or losing his license to do his field and prepare tax returns? Or is he more worried about saving you lots of taxes? I think you know the answer to that. And there are good CPAs out there. They're good tax preparers, but the IRS has basically stacked the deck against them. Now, it's not just the tax preparers, it's the taxpayers himself. And it's fear of the IRS, and therefore no tax planning is done. Here's the statistics. 25% of Americans are afraid of an IRS audit. And for those over 65, a third fear being audited during their lifetime. And we all know the fear when that brown envelope State Department of Treasury comes in our mailbox. And also, this is really totally on the taxpayers. Most taxpayers look for the cheapest way of doing a tax return, the guy that'll do it or the gal that'll do it for the cheapest fee, or millions do it themselves in TurboTax. In other words, they're unwilling to pay for major tax planning. And let me be clear, tax preparation is just adding up the numbers accurately and putting on the right line of the form. That doesn't save you any tax. Tax planning has to happen before December 31st. So when you file your returns on April 15th, or this year, May 17th with the extension, the numbers are exactly the way you want, and the amount of tax you owe is exactly the way you want. Tax planning is more important than tax preparation. Now, for most people, particularly from baby boom generation on down, Generation X, millennials, the generation younger than millennials, almost everyone of that age bracket, most of their savings is in an IRA, a 401k. For you working as teachers, maybe it's a 403b plan. For you federal employees, it's a 457 thrift saving plan. But the only reason most Americans save is because they got the inducement of a tax deduction. I write a financial column for 3 newspapers in the Ahwatukee and Chandler area of Arizona. And I will tell you, when I wrote an article last summer, the average savings rate in America was only 7.6% of after tax income. The only reason people save is because they get a tax deduction. But you're creating a ticking tax time bomb, and 90% of folks have no idea what they're doing. Let me explain. Let's suppose over the decades, you deposit 300,000 to your IRA or your 401k. And then you ride the stock market, the ups, the downs, roller coaster. And luckily, at 65, when you want to retire, it's worth $1 million. That full million is taxed as ordinary income whenever you take money out to spend. You get no capital gains, you get no tax benefits. It's all ordinary income. Now, suppose you don't spend it all and it becomes 2 million 10 or 15 years later. And then you and your wife get hit by a drunk driver. The 2 million gushes out, it's taxed as ordinary income, and your heirs, kids or grandkids, pay at least 40% between federal and state of 2 million and 800,000 tax. The IRS loves you. You deducted 300,000 that you contributed over the decades, and yet you pay tax on 2 million. The IRS loves that ratio. There is a solution. It's called the Roth IRA. And here are the rules. But what I found, and normally before the coronavirus of 2020, I would give 40 to 80 talks a year. Thousands would attend my events. Hundreds would see me for the free strategy session. And here's what I found over the last 11 years. Only 2% of the population has 30,000 or more in a Roth IRA. The reason is folks can't stand the pain of not getting the immediate tax deduction by contributing to an IRA or 401k. And they can't take the pain of converting 100,000 from a traditional IRA or 401k to Roth IRA because that creates 100,000 taxable income. Remember, you're not paying an extra tax. That tax always would have been there, but people can't take the pain. And the pain's going to be a lot higher. Joe Biden's the president now, and with his administration, they want to raise taxes by at least 3.42 trillion. And they're raising all sorts of taxes. Now, if you're high income with the Biden tax plan, when you combine federal and state taxes, this is why people are leaving. California is going to be a 62% marginal tax rate. New Jersey, 60%. New York State, 58%. And New York City has their own city tax. So when you combine New York City, federal, and state tax, it's 62% is the marginal rate. And that's why there's a flood of people going to lower no tax states such as Nevada, Texas, and Florida. Now, there are many ways that in the tax plan they want to raise it to 3.4 trillion. But one of those is if you're high income, There's not going to be any capital gains. It's all going to be taxed as ordinary income. Your tax rates would basically double. Right now, there's a maximum 20% tax rate on long-term capital gains, assets, whether it be real estate or business, stocks held more than 1 year, and also add a day to it. And now they're going to tax it as ordinary income. By the way, California leads the nation in many things, such as Silicon Valley, Hollywood. Guess what? For the last number of years, people are shocked to find out in California, there's no capital gains. California has a maximum of 13.3% state income tax rate. And for the state, they will tax anything that you thought was capital gains, they'll tax it as ordinary income. And Biden wants to do that on the federal basis. Now, if you want to protect against higher taxes, call me at this number 480-706-0177 or go to mycalendly.com link. And Susan Ratliff, my education director, should be putting that on the chat box. And the time is to act now. It's not to wait till next April 15th. It'll be too late by then, and you have to pay whatever tax is due. Now, let's go more into a visual representation of the Roth IRA conversion. If you stay in a traditional IRA, 401k, 403b, you're in forever tax. Any money that comes out of it, either forced through a required minimum distribution or when you take it out, just suspend it in retirement, it's taxed as ordinary income, just like wages, because it's really deferred wages. And in a sense, it's fair. The IRS has been waiting 20, 30, 40 years to finally tax you. So you get no tax benefit from a traditional tax deferred account. But if you convert it to Roth, this is the holy grail of tax planning. Once you convert it to Roth, there's no tax, and I was picking the guys as the guys passing on first, particularly because in a lot of marriages, the wife is a bit younger or sometimes substantially younger than the husband. So let's pick on the guys. So the guy has money in a Roth IRA, and let's say he's 60 and he doesn't pass on until 90. Well, for the next 30 years, for that money in the Roth, no matter how much he earns, there's no tax. If he's got 100,000 in a Roth and it goes up to $1,000,000, pays not one penny of tax. Then he gets hit by a drunk driver, not his fault, and his wife inherits a Roth IRA. And let's say she's around another 10 years to 100. If she takes that million that's in a Roth IRA and she doubles it to 2 million, no tax. Now she passes on and it goes to, say, the kids or grandkids. For the first 10 years on that 2 million that they inherit from mom or grandma, if that 2 million goes to 4 million, there's no tax on that as well. Now at the end of 10 years, they've got to distribute that 4 million in our example. And from that point on, if they invested and earns interest or stock dividends or short-term and long-term capital gains, then they're taxed on earnings, but not for that whole period. So we're transforming from forever tax IRAs and 401ks to never tax Roth IRA. Just a holy grail of tax planning. Now, the Secure Act was officially enacted on January 1st, 2020. It increased the year when you have to take the required minimum distributions from your IRA or 401k, increased it from age 70.5 to 72. It abolished a multi-generation Roth IRA lasting for 3 full generations. And now it's limited to the parents' lives and the first 10 years for the kids and grandkids who inherit the Roth IRA. Now, here are the Roth IRA rules. For there to be no tax on your earnings, you must be at least age 59.5 before you pull money out, and you have had to have your first Roth IRA for at least 5 years before the first withdrawal. So if you're not sure if the Roth IRA makes sense, here's what I tell everyone. Go to your bank or savings loan and ask them, what's the minimum I need to open a Roth IRA? And convert Maybe it's $100, maybe it's $500. Convert 100 or 500 of your traditional IRA to a Roth IRA, and now you've opened your first Roth IRA, and you set that time clock rolling. So if 5 years from now you convert 200,000 to Roth IRA, at that point you've fulfilled the 5-year rule, and any earnings are tax free. Now, withdrawals of money you deposit in a Roth IRA are not locked away. If you deposit 100,000 Roth IRA and you have an emergency where you need 10,000, you can always pull it out without any penalties, and it's tax free because you've already paid the tax on the Roth conversion. Now, next, this is very important. No required minimum distributions are required from Roth IRAs, and so you won't be hit with the 50% penalty if you make a mistake and you don't take enough out, or the required minimum amount from your traditional IRA and 401k. And believe me, a lot of people make a mistake, and this 50% penalty is about the highest that exists in our US tax code. Let's go to case study. Case study number 1. A client age 60 converts $1 million to Roth IRA. He can earn 10% and he's in the 40% tax bracket. So $1 million earning 10% is 100,000 a year. If he's in the 40% tax bracket, that would be 40,000 a year of taxes that he will save by having that money in a Roth IRA. Times 30 years, that's 1.2 million of taxes saved. Now, here's the key, and you probably never heard this from your CPA, your taxpayer, your financial advisor, your stockbroker, your realtor, your banker. If I can eliminate the tax normally owed on a Roth IRA conversion, is there any logical reason why you would not want to save 1.2 million in taxes? Remember, the only reason virtually no one does a Roth conversion, whether it be 100,000, 300,000, 500,000, or a million, is because they can't stand to pay that tax. But stick around. In this webinar, we're going to show you the most powerful strategy in the tax code where we can eliminate the tax on Roth conversions or just your normal high income. Now, how a Roth IRA affects your Social Security retirement income. If you have lots of money in a Roth IRA, you can choose investments that have a higher rate of return because you're not worried about tax. With higher cash flow, you can wait until age 66, 67, or even 70 to get your maximum Social Security income. If you take Social Security at 70 instead of 62, it can give you 10 to 20,000 a year more Social Security income. Now, as a public service, over the years, I've done, usually twice a year, a seminar for federal employees, particularly the VA employees in Phoenix who take care of our wounded veterans. And by the way, a lot of employees from the Social Security Administration show up, and they have no idea that the decision on when to take Social Security can be $1 million decision. And let me explain. I did a composite of 3 people that were at the seminar that came in to see me. They were all single females, divorced or widowed, and one was a pharmacist, one was a nurse, and one was a nurse practitioner. And what we found that if they took Social Security at 62, which almost everyone does, the earliest you can, their Social Security retirement income was about 20,000. Whereas if they waited to 70, it would be twice as much. It would be 40,000 a year. Now, why is that $1 million decision? The average stock market dividend you get in S&P 500 companies for the first 20 years of this century, starting January 1, 2000, is only 2.02%. The average you could get lending to Uncle Sam on a 10-year or 20-year treasury bond over the last number of years has only been 2%. So bear with me. If you get 20,000 a year more Social Security income, that's the equivalent of saving $1 million more, getting a 2% cash flow to generate that same 20,000. So what I asked these federal employees, What's easier, waiting 8 years to take Social Security at 70, which only 3% do, instead of 62, which almost everyone does, or saving an extra $1 million? Well, you know the answer. So, but that's how a Roth IRA can affect your Social Security income. Now, call me, take action right now. Call me at 480-706-0177 after the webinar to maximize your Social Security or other retirement income and reduce taxes, or go to the calendly.com link and you can book your 45-minute absolutely free strategy session with me to ask me anything you want in the world of money. Now let's go to the most powerful strategy in the tax code: solar business investments. We've all heard about the new Green Deal. Well, even before President Biden got elected, this is what's happening in our tax code. And there's a tax white paper that I can give you when you come in to see me for your free live strategy session. Now, our first one we'll handle by phone for 45 minutes. And after that, almost everyone wants to come in to see me. And sometimes we'll spend 2 hours absolutely free in person, covering anything to do with improving your retirement income, reducing your stock market risk, and reducing and eliminating taxes. At the end of 2020, we had an emergency extension of the solar tax credit. So extends it at its 26% level for 2 more years, for 2021 and 22. So the time to take action is right now. The Section 179 allows the immediate deduction of business equipment instead of having it depreciated over 5, 7, 10, or more years. Section 179 has been in the tax code since 1958. Before the Trump tax law, it was 500,000 per year. After the Trump tax law, it's a million or more. And Section 179 is designed to create jobs. If someone can buy more equipment for their business, you have to have more employees to operate the equipment, and therefore more people get paid. So it's a very useful part of the tax code. So here's an example of using the solar tax credit and depreciation or Section 179 with solar reefers. A reefer, I'm not referring to marijuana. A reefer in the food industry refers to the 1-ton physical weight air conditioning unit that attaches to the front of a food trailer. Only 2 companies make them. They're all diesel powered. Carrier, like Carrier Air Conditioning, owned by the giant United Technologies company, and Thermo King, owned by Ingersoll Rand. But then my company has the invention. We're the only ones in the world that have invented a solar powered reefer. That's 100% zero emissions. In fact, again, California leads the nation. California has tough rules, and their goal is to have half of all energy be clean energy by 2030, generated by clean sources such as solar or wind power. Now, California has had many meetings of the food and trucking industry, and they've publicly stated we have the only technology that's commercially viable and is zero emission. So here's a leasing program. An investor puts up 60,000 and he buys a complete solar system. The brand new reefer, the momentum generator underneath the food trailer, the top of the food trailer is totally covered with solar panels and lithium-ion battery packs to store the energy. 7% annual earnings is paid out, and it could be tax deferred by depreciation based on the power you generate. Your security. A universal commercial code is a UCC filing, and it acts like a first mortgage for real estate. By the way, most people don't know what a UCC filing is. Think of the pink slip on your car. That's what a UC filing is. Now, you have a choice in terms of depreciation. Your cost basis under the tax code, you take 60,000, and you subtract half of your 26% solar tax credit. And so you come up with 52,200 is your cost basis. If you divide by 10 years, that's 5,200 of deductions a year. Anyway, 5250, but who's counting? Now, if your 7% of your 60,000 investment is 4,200 of income, notice that you have more depreciation, thin earnings, and so you don't pay tax on your earnings for the next 10 years. Now, if you're in a 30% combined federal and state and city tax bracket, getting to keep 7% is the equivalent of making 10% and losing 3% in taxes. Now, how does it work? Your tax credit is 26%, your federal solar tax credit. 26% of 60,000 is 15,600. You subtract that from your 60,000, subtract half of your tax credit, and you come down to your cost basis. Now, one can either depreciate over time, but a lot of people, particularly if you're going to have high income due to Roth conversion, you want to take Section 179 and just deduct that in the year you place that equipment in service. So let's look at the numbers. Just taking the tax credit alone, if you subtract the 15,600 tax credit from your 60,000 check you wrote, your true cost of your investment's only 44,400. Your income's 4,200. Divide that by your net after-tax costs of 44,400, and you're making a 9.46% net after-tax return. Bottom line, solar reefers generate a much bigger tax savings and a larger cash flow than the stock market does. Case study number 2. I met these folks. He was 73, a retired engineer. She was a retired office manager. Their normal taxable income, including in 2020, was 100,000, but they also wanted to do 100,000 Roth conversion. And they also wanted to recover taxes paid the previous year in 2019 when they had a bumper banner year, 152,000. And they also want to earn a higher cash flow than what banks, bonds, and stock market dividends pay. So here's how we did it. They purchased 2 solar reefers. Now their taxable income's 200,000, the normal 100,000 plus 100,000 from doing 100,000 Roth conversion. Normally they'd owe 36,159 in federal taxes, but now we take Section 179. That deduction of 104,400 lowers their taxable income by more than half, and they would normally owe 12,612. But no, they owe 0 because of that 31,200 solar tax credit. So they owe 0 in 2020, but guess what? They've got 18,588 of extra solar tax credit, and it can go back 1 year and recover up to all the federal taxes they paid. So guess what? Instead of having to pay in for 2020, they reduce it to 0, just like President Jimmy Carter did when he got elected president in 1976, and they recover tax previously paid. And the law works for everyone. And no, you do not have to get elected president to take advantage of this great tax strategy. So let's go to the rate of return analysis, or ROI, return on investment. We had the 2020 federal taxes saved, the 2019 federal taxes recovered, and so the net after-tax investment, your taxes save about half of the cost of the reefers. You add your income, 7% of 120,000, 8,400, and so the rate of return is 12.87%, not counting the Arizona taxes saved. If we add Arizona taxes saved, the rate of return is 14%. A rule of thumb that we have is if you're reasonably high income, whatever the cost of a reefer is, 60,000, you're going to save about 30,000 in taxes. So Uncle Sam truly is now your rich uncle. He will cover half the cost of you buying reefers, which will make you also a hero for the planet to decrease dangerous diesel pollution. It's a practical way of doing the new Green Deal. So again, if this is interesting to you, at the end of the webinar, call me at 480-706-0177 to earn a 7 to 10% plus cash flow and reduce your taxes. Or go to mycalendar.com link and book an appointment for 45 minutes to cover anything you want. Now, moving on. If you don't do any of this planning, you're going to let the IRS hurt your kids and grandkids, assuming anything's left that goes to them. You don't want to do that. Let's go to case study number 3. In 2020, a client couple converted a bigger amount, $252,720 traditional IRA to the Roth IRA. Also, his income, he's a window and door salesperson, dropped in half due to coronavirus in 2020. So their total taxable income was $300,566, of which $252,720 was due to the conversion of a large amount from a traditional IRA to a Roth IRA. But because of the reefers, they pay zero federal tax. In fact, I set up a private pension for them with that $252,720, and in 5 years, when she triggers it, it's going to generate $22,097 of annual tax-free income for life. So that's a substantial rate of cash flow when they deposited maybe about 230,000. It's about a 9% rate of cash flow, but best of all, it's going to be safe cash flow to allow them to enjoy their bucket list dreams, and it's going to be tax free. So basically, you decide how much you want to pay in taxes based on your tax knowledge or the tax knowledge of your advisors. So you decide how much you want to pay to Uncle Sam, your governor, your city, if it's got a city income tax, or you could keep it for your family. Now, people normally see me for 3 major reasons. One, they want a dream retirement, and usually that means increasing retirement income substantially. If you give me 5 to 8 years to let our strategies percolate and work for you, it's not unusual. In probably 80 to 90% of cases, I can get people 20, 30, 50,000 more retirement income than what they thought was possible. In fact, it reminds me about 9 years ago, he was a retired firefighter on disability, and she was a teacher. Neither one of them high paid. And when we looked at when they planned to take Social Security, and she had a pension that was about 30,000 a year from the state of Arizona, because she had taught for over 30 years, it looked like the retirement income was about 61,000. And they said they could get by on it. But they gave me about 8 years to let our plans percolate. And when they finally trigger it, guess what? They're going to have about 161,000 of steady retirement income, not depending whatsoever on the stock market. So in their case, I was able to generate 100,000 more retirement income than they thought was possible. So it's increasing and maximizing retirement income is a major reason people see me. Second, reducing stock market risk. How can you enjoy life if you never know when the next stock market crash will be and you'll lose 20 to 50% of your life savings? And the third reason is to reduce or eliminate taxes. Now, you have a choice. What future do you want? I find that most people have 80 to 90, even 95% of their savings in the stock market because they don't know there are other alternatives. And then every time we have a crash, it's huge. The dot-com crash of 2000 to 2002, the NASDAQ index, tech stocks dropped by 78%. So can you imagine saving your whole life? And now in December of 1999, you've finally reached heaven. You've got $1 million of financial assets, but it's all in tech stocks in the NASDAQ index. And then when a dot-com crash occurs, you drop 78%. You're down to 220,000, but after annual fees for 3 years, because the stock market dropped in 2000, 2001, 2002, you're down below 200,000. Isn't that getting wiped out to go from 1 million to under 200,000? Then we had the real estate crash, which triggered the 2008, 2009 crash. Again, the stock market dropped by a little bit more than 50%. Then starting in March of 2020, the coronavirus panic. It only took 5 weeks for the stock market to drop by 30%. Now it's had a rebound, but in my opinion, the stock market levels are ridiculous. They bear no measure of connection to the real economy when 20 million people lost their jobs and at least 10 million haven't gotten their jobs back. So we've never had such a disconnect between stock market levels and the real economy. So you've got a choice. Do you want your retirement to be volatile crashes, totally unpredictable black swan events that no one could have foreseen, or steady growth? Let's go to case study number 4. And economists, I got my PhD in economics at UC Berkeley. Economists have a term, it's called economic opportunity cost. So what I'm going to cover, the economic opportunity cost of not saving taxes. So let's go back to the example of a client that does a $1 million Roth IRA conversion, and therefore he's not going to pay any taxes, even though he's in a 40% combined federal and state tax bracket. The client can earn 10% or more without stock market risk using Dr. Wong alternatives. 10% of a million's 100,000 a year. So by having it in a Roth instead of a traditional IRA, he's going to save 40,000 a year of taxes. Now, that's not all. So let's go on. How do we calculate economic operating costs? Go to a financial calculator. For 30 plus years, I've used the original one, the Hewlett Packard 12C financial calculator. You put in these keystrokes, 40,000 a year, which is the annual taxes saved. You put in the PMT or payment function. Next, 10% annual rate of return, put in I function. Then for 35 years, put in N, number of years. And then you click FV, which stands for future value. By saving 40,000 a year of taxes and investing at 10% for 35 years, this creates just under $12 million more net wealth. And I looked at the client, a very sharp guy, but he had no clue that a Roth conversion could do this. And I looked him right in the eye and I said, is there any logical reason why you would not want to add $12 million of net wealth to your family? And of course, he said no. Now, again, $1 million is a big example, but we know almost anyone that's a reasonable saver has saved at least 200,000 in their 401k and IRA. So let's suppose you could only convert 200,000. Well, it's everything straight line prorated. If you convert 200,000 under the same scenario, it will still add 2,385,014 increase in net wealth. So I'm looking you straight in the eye, you folks attending this webinar, is if I can get rid of the tax on doing a 200,000 Roth IRA conversion, is there any reason you would not want to add 2.3 million more net wealth to your family? And hopefully the answer is, of course, you'd love to do that. Now, I promised I would tell you how I'm going to save Whole Foods a lot of tax and also save the plant from dangerous diesel pollution. We're going to use solar reefers. Again, we're the only ones in the world that have invented it. Of our 9 owners, we have 4 PhDs. And yes, a lot of brain power. Over the last 13 years, 3 patents issued, 3 more pending. We are the only ones in the world that have invented this. Whole Foods, and you've probably seen the ads. In fact, a lot of companies have ads, whether it be Ford, whether it be Federal Express, whether it be Whole Foods, whether it be Amazon, where they pledge to get to net zero carbon or at least lower their diesel emissions and fossil fuel emissions drastically. Whole Foods is owned by Amazon. It's committed to clean energy. Whole Foods wants to buy 400 solar reefers and save lots of tax. Whole Foods will be able to cool their food with 3 times the coefficient of performance and reduce spoilage. Let me share, every industry has got its search secrets. And so let me explain, a lot of the food problems you've heard about, it's not just because it's bad lettuce at the growing area. In a food trailer, there are two areas. The reefer cools the frozen area, and then the rest of the food trailer, meat and dairy, still got to be cooled down to 35, 37 degrees. After the webinar, just go to your refrigerator and check your temperature. Typically for the refrigerator area, be set around 37 degrees. We have measured the back of a food trailer in summer at 4 p.m. when it's super hot at 60 degrees. Here's why. When it's 90 degrees and 90% humidity in the southeast, Florida, Alabama, Louisiana, Georgia, Mississippi, or was 110 degrees in August in Phoenix or Nevada, not as much humidity, a diesel power reefer absolutely can't keep up. The coefficient of performance of a diesel power reefer is 1. Our coefficient of performance is 3.0 to 3.1. So we have 3 times the cooling power. And so guess what? You don't want your sour cream or your chicken or your dairy to be at 60 degrees, sitting there for hours during a day, slowly warming up. Whereas we can blow as low as minus 48 degrees, so we can actually cool not just the freezer part, but also the rest of the food trailer. And Whole Foods will cut dangerous diesel fuel use by 50%, and it'll cut diesel pollution that kills folks. Here's the deal. We targeted the top 10 owners of diesel power reefers, giant companies you've all heard of. They all came into our manufacturing plant in Mesa, Arizona, in the Phoenix metro area. And here's the bottom line. In a day, it takes as much diesel to power the diesel power reefer as it does the semi truck that pulls the food trailer. With our technology, they're not buying any diesel ever for the reefer. So it will cut the diesel bill for these giant food companies by half. And by the way, diesel just doesn't cause lung cancer. Medical studies have shown that about 25% of all deaths by stroke and heart attack come from diesel, fossil fuel, dangerous diesel and gas fossil fuel pollution. So again, you get a chance to be a hero like Whole Foods is for the environment. Now, in retirement, happiness is not worrying about money. Here's what I tell everyone. We have a little logo that I show you when you come in. The bottom rung is financial freedom. My goal is to help you achieve financial freedom. If you have freedom of time and money, you can now pursue optimal health, the next level up. You can afford to hire chiropractors to pay out of your pocket like I have since 1980. In other words, if you need physical therapy, you go as often as you want, not just the limited visits your insurance will pay for. If you have freedom now of time, money, and optimal health, the rest is up to you. Can you climb the pyramid to do things and be with people that get you happiness, joy, and love? Love being the top of the pyramid. That's all on you. But my job is to help you get financial freedom. Provide for your grandkids. Again, in retirement, should just be doing things that give you enjoyment, happiness, joy, and love. Now, here are the key questions you have to ask yourself. And again, when you deal with me, you'll find the process is totally different than dealing with stockbrokers, financial planners, insurance agents, realtors. First question, do I want to pay lots of tax for the rest of my life? Or would I like to cut it in half or cut it even to zero? The tax law says you have the right to pay as much or as little tax as your presidents or your governors or even these giant corporations whose products you use, like Amazon, General Motors, IBM, Netflix. Do I want a higher retirement income than what I can get from bonds, banks, and dividends? Do I want to reduce my stock market risk? Do I want to even reduce it to zero? Or do I always want to go through retirement never knowing when I'm going to lose 20 to 50% of my life savings, and I don't have in retirement 20 years to work and make it back? Do I want to convert my IRAs and 401ks that are forever taxed to Roth IRAs that are never taxed. And bottom line, how important is it to never have to worry about money in retirement? Only you can ask that question. And the traditional solutions that 95% of the financial advice field give you involved having most of your money in the stock market or the bond market. And you never know when you're going to have a crash. Our research 40 to 50 years ago at Berkeley, where I got my PhD in economics, and Stanford, we had a joint research group on the stock market, and we found it was heavily rigged. It's a heavily rigged game for the benefit of the insiders, just like a casino. And if you play any game at the casino, who's going to win? Well, you know the odds favor the house. So we've covered a lot in this webinar. So if any of these issues are important to you, I'd encourage you at the end of the question and answer period, at the end of the webinar, you can either call me at 480-706-0177, or better yet, click on the calendly.com link and you can see my schedule for the next week to 2 weeks and just schedule your free strategy session. Now, I'm so confident that I can save people taxes. Yes, our first contact is going to be that 45-minute phone call, and you can book your time on Calendly. But after that, almost everyone wants to come in and see me live. We typically spend 2 hours. There's absolutely no charge. You bring in your tax returns. You bring in an estimate of anything changing for 2020, 2021. You bring in the full statement, the last major statement of all your major financial accounts, IRAs, 401ks, bank, brokerage, and so forth. You bring in a list of questions, and we take a holistic look at your whole retirement and tax situation. But here's my special offer. If I can't reduce your taxes, show you how to reduce your taxes by 50% or more, I will pay you $300 at the end of your free live strategy session. I'm that confident that I can do that. And I've been doing this for 40 years now. And finally, this last slide shows a goal for a lot of folks. A lot of folks want to retire early, and they also want to retire happy, and they don't want to have the stock market risk. So basically what I say is retire early and happy without Wall Street risk. And again, maximize your retirement income, reduce or eliminate taxes on your current income and your future required minimum distributions from your IRAs and 401ks. I'm Dr. Harold Wong. My physical office is in Tempe, Arizona. Almost anyone in the Phoenix metro area can get to my office within 30 to 40 minutes. And I look forward to seeing you. And at this point, we're ending right on schedule, but we're not ending now because we're now going to take some questions and answers. And Susan Ratliff, my education director, is handling that part for me. So how do we handle the technology now so I can see the questions or hear the questions and be able to answer them?
I'm ready, Dr. Wong. That was really informative, I'm sure, for everyone else, because it sure was for me. I do have a question from Eugene. He says, I'm already retired. The wife is still working for another 4 to 6 years. Can you help us save on taxes?
Oh, absolutely. Your wife is working for 4 to 6 years, and that's good because that means if she retires 6 more years and has not taken Social Security yet, you're adding to her future Social Security retirement benefits. Absolutely. By the way, I see people that are 80 years old. I see people 75. I see people as young as 50. But the common age of folks that I see is typically 55 to 75. But yes, I seen people that are even older than 80? Absolutely, and I can still make a big difference for them.
I want to draw everyone's attention to the chat box. If you run your cursor at the side of the screen, you'll see something that says chat. I don't have any other questions at this time, so Let's see if anybody else wants to place a question. Just type it into the chat box and I'll ask Dr. Wong to give you some answers. Any questions, anyone else?
Don't be shy. I cannot believe that we don't have more questions. When I give a normal 2-hour live seminar, when we could do it, I would spend the next hour handling questions. February 15th, I did a webinar for the Sun City West Investment Club in Sun City West, Arizona. The webinar was an hour and I had an hour of questions. So we didn't click off until 2 hours.
Well, for anyone who can't find the chat box or are a little shy to ask questions this way, be sure to give Dr. Wong a call. He'll be available right after the seminar to give you a private answers to your questions. You can reach him at 480-706-0177. He also is taking personal consultations. Like he said, beat him for free. It costs you nothing to get some excellent information. And just go to his Calendly calendar and book your appointment. Doesn't look like any other questions at this time, Dr. Wong, but I'm sure you'll be getting some phone calls from interested parties because it was some fascinating information to improve people's economics and their saving on taxes.
So I'll just have to ask the IT person that's monitoring the Zoom call. Sean, should I click stop share at this point?
Hang on, Dr. Wong.
That's
Here
what
comes.
You will click on stop share, the red button on top.
Should I do that now?
No, not yet, Dr. Wong. Here's another question.
Okay.
Is it better to itemize versus standard?
Well, all I can tell you is that the standard deduction with the Trump tax law that took effect in 2018, it basically almost doubled the standard deduction. Very few people itemize, but it's simply a matter of adding it up. Right now, for a married couple, the standard deduction, if you're under 65, could be as much as $24,800, and you get a little bit more if you're 65 or older. So most people don't have that much in itemized deductions. So anyway, it's simply a matter, add it up either way. So Schedule A is your itemized deduction schedule, add it up, how much your allowable medical deductions are, your interest is, which for most people is mainly their mortgage interest, taxes, and then your contributions. Just add it up. It's a simple one-page form and see if it exceeds what the standard deduction is. So great question there.
Dr. Wong, we still have people on the line. You probably have some average questions people usually ask. Do you want to bring some of those up and give us some answers?
Sure, absolutely. Let's cover again, how is it possible to eliminate Wall Street risk and stock market risk? And I'm going to give you something that may be a little humorous, but it's absolutely true. How do you eliminate risk of losing your money at a casino? Simply, you don't put your money on any of the games, whether it be roulette, blackjack, Keno, the poker table, or the slot machines. The only way to not lose at a casino, and you know the odds favor the house, they don't build brand new casinos in Las Vegas that cost over $1 billion and hold 5,000 employees and 5,000 guests if they're losing money. So you just don't play. Similarly, for most people, all they know is the stock market. By the way, Wall Street has really done a fantastic job for them. With IRAs and with 401ks, unless you know a secret, which 98% of CPAs don't know, your money is stuck. You can only buy Wall Street investments. which for most people are stocks, bonds, and mutual funds. You can't take your 300,000 out and go bid at the foreclosure auction. By the way, there is a secret way we can do that and allow you to do what are called alternative investments, such as rental houses, different real estate formulas, lending. Um I own part of a real estate company where we have 8 different real estate formulas from mini storage to lending and so forth. So that's an advanced IRA strategy where you have to have what's called a self-directed IRA. And there are only maybe 5 to 10 trustees in the country that you feel safe having your money that allow you to do what are called alternative investments, meaning alternatives to Wall Street. So basically, for 40 years, and this really does set me apart from anyone else you're going to talk to. For 40 years, based on the research we did at Berkeley and Stanford, where we found out Wall Street was a rigged game, I've never suggested a single client buy anything sold by Wall Street. No stocks, no bonds, no mutual funds. I found alternatives to Wall Street, whether it be income producing real estate, whether it be private pensions where you have zero stock market risk and you get a high cash flow, or whether it be equipment leasing where you have control over it, that have done much, much better. And let me just give you an example of a private pension concept. She was a nurse, 62 years old, and working and doing a good job, director of training and education of the state mental hospital. We deposited 270,000 in a private pension, and her plan was to work until 70 to maximize Social Security. And if she waits 8 years from age 62 to 70 to maximize Social Security, when she triggers her private pension, she will get 27,000 a year. Now let's look at the rate of cash flow. 27,000 of annual income divided by 270,000 deposited, that's a 10% rate of cash flow. Now let's compare that. If it was the typical 2% stock dividends, 2% of 270,000 would be 5,400 of income, but that income's not guaranteed. If we have a recession, what do companies do? They cut the dividend or they eliminate it to save cash so that the company doesn't go under. So think about it in practical terms. How much fun could you have in retirement with 5,400 of income versus 27,000 a year of income? Obviously, it would make a huge difference in your retirement lifestyle. So these are just examples of what I've been doing for 40 years. And again, this is also what the big boys do as well.
Dr. Wong, if someone's already invested in the stock market, you can certainly just discuss with them a portion of their investments for tax deductions, right?
Oh, absolutely. It all gets down to how much are you willing to risk? If you have all your chips, let's say you save 500,000 and you have all the chips there in the stock market. Imagine being at a poker table and you push all 500,000 chips there. It's there right now, totally at risk. In our strategy session, we would determine how much are you willing to lose. If you say it would drastically affect my lifestyle and my bucket list dreams in retirement, and maybe not being able to help my grandkids go to college if I lost more than 100,000, the answer is a very simple mathematical answer. We would have to find an alternative to the stock market for 400,000 of the 500,000. If
I have
it's not
another,
in play, you can't lose it.
I have another question for you. That's a good answer, by the way. If someone has $500,000 in taxable IRAs, what at what rate do you suggest over years that they convert to the Roth? 100,000 at a time, or?
Well, here's the deal. Traditional thinking for the relatively small number of CPAs that look at a Roth IRA conversion, and by the way, very few do. Here's why, and it's not all their fault. A CPA could be a great educator. Explain if we convert 200,000 to a Roth. Now understand your normal taxable income is 100,000. If you convert 200,000, now you're going to have 300,000 taxable income. And then if if you have no other deductions, guess what? You may pay 70,000 of federal and state taxes. And you explain that. But then a year from now, when he files the tax return, the client says, "Oh, ouch, 70,000 tax." And then unfortunately, we're a blame society. The typical taxpayer say, "Well, that CPA or tax preparer, he done me wrong. It hurts to pay the 70,000, even though he honestly explained everything to you, the advantages and disadvantages." And then you get mad and you pick someone else next year to do your tax returns, and that CPA or tax preparer lost you as a client where he could have done your tax returns for the next 10, 20 years. That's another reason why tax preparers and CPAs rarely talk about a big Roth IRA conversion. But the few that do, what they say is, I think, an unsatisfactory answer, also logical. They say, okay, if you can convert 50,000 before you hit the next tax bracket, only convert 50,000. But in my case, you can convert the whole 500,000 because we have strategies to wipe out the tax. So you don't pay any tax on the 500,000 conversion. What that allows is for my clients to convert much more quickly into the Roth IRA and then much more quickly enjoy the benefits, because once you get that money into the holy grail of the Roth IRA, no matter how much you earn, there's no taxation whatsoever. And also no required minimum distributions. So you're not forced to pull money out even if you don't want to.
Makes sense. So it's a great strategy for two individuals who are retired and not making an income other than Social Security. It's a perfect strategy for people who one is working, one is retired, and it doesn't matter, right?
Doesn't matter at all. Whether you have medium or high income, and high income could either be high job income, high retirement income, or high income due to Roth conversions. It doesn't matter. We can reduce taxes to whatever level you want. But it's not just reducing taxes, it's also increasing your cash flow, your retirement income. See, a lot of people tell me, "Dr. Wong, I was hoping to have 50,000 a year of retirement income and I can get by. I can't do a lot of my bucket list dreams, but they're thrilled if I can get them 20 or 30,000 more retirement income, because with 20 to 30,000 more, for most people that they can afford their bucket list dreams." They said, "I wouldn't mind if you could give me 30,000 more income from 50 to 80,000. I wouldn't mind if I had to pay 10,000 taxes on that. So I still got 70,000. That's still 20,000 more spendable income." So again, we have concentrated mainly on the reducing taxes. But again, for a lot of folks, there are three reasons they see me. Number one is to just increase their retirement income. Two is to reduce getting wiped out by stock market crashes. And third is to reduce or eliminate taxes. Again, with the age bracket that I see, most of them are 55 to 80. And if you're high income, I see people younger that just want to reduce taxes. But if you're 55 or 65, you've been paying taxes for 3, 4 decades. I think you've done your share, because you've been paying taxes more than what Amazon did in 2017 and 18 on over $15 billion of profits. I think you've done your share.
So you can actually help both younger generation just starting out in the workforce as well as retirees.
Yes, we just had a tour of our reefer plant, and he was about 53. He was an engineer, and his wife was about the same age, but she was a pediatrician that's dealing with young kids. And what was exciting to her was the fact she realizes the effect of dangerous fossil fuel, gas, and diesel pollution on the health of young folks. So she felt like a hero to the economy and a hero for the green revolution, the practical green revolution, to do her part, because she understands the dangerous effects of fossil fuel pollution. Again, we're not talking pie in the sky. I can't solve global warming and all that and the seas rising. But in this giant food and trucking industry, we can at least cut their diesel pollution in half because they're not going to have to buy diesel.
You know, I was also thinking, and tell me if this is important, it's only April. So starting now at the beginning of the year is really smart, probably, to be able
It's
to.
a great point. You want to do your tax planning right now. If, for example, you like the solar reefer strategy, we need at least 3 months to build it. So for example, let's say you come in and see me, and let's say by May 15th, you say, this is great. I want to buy one reefer or more and save my taxes this year, maybe recover taxes paid last year. If it's May 15th, we need at least 3 months till August 15th to be able to build it. And guess what? You can't take these tax benefits unless it's placed in service in this year. So we've got to place it in service no later than the end of December this year. But guess what? There's supply shortages because the lithium-ion battery packs and the solar panels come from Asia, in particular China. And with the trade war, tariffs, and the geopolitical back and forth, sometimes it takes a lot longer to get the materials for us to build you your solar reefer.
Of course, you can assist someone who's maybe not looking to invest in the solar reefers due to the price or whatever, or
Oh,
fear.
absolutely. We have lots of other strategies as well.
Excellent. Well, I don't see any other questions. Dr. Wong, is there any final tips and that you want to leave the audience with?
The only tip I have is just you have to take your financial and your retirement future in your hands. And there's a saying attributed to Albert Einstein: the definition of insanity is doing the same thing over and over again and expecting a different result. If you want to avoid stock market fluctuations and stock market crashes, you can't have all your chips in Wall Street on the front of the poker table. If you are unhappy with the ridiculously low interest rates that anything that pays interest pays, whether it be banks or bonds, you can't have your money with them and get nothing. So you have to do something different. And with me, you get access to the strategies that the big boys use. If I can save giant companies millions of dollars of tax, I can certainly save the average person 10,000, 20,000, 30,000, 50,000, or 100,000 more of annual income tax.
Thank you so much, Dr. Wong. Thank you, everyone, for attending. I hope you will reach out to Dr. Wong by phone or book a consultation with him on Calendly. If you don't have that information, it's on the slide, and we'll hope to see you again soon.
And for our IT person, should I click the stop share now?
Yes, indeed. The red button that says stop share on top. And then on the bottom right, you're going to see one that says end. And then end for all.